South African markets have started on an interesting note. The rand has been very weak from the start of the year, and that was despite global demand for emerging market assets, and equally what we've seen in the bond and the equity market, where certainly we've seen prices continue to go up and bond yields continue to decline. And the irony with the rand is that while the rand has been very soft, it really predates back to the fundamental news that we had at the end of last year, where we saw the current account deficit balloon quite substantially in the second and the third quarter, and then of course compounded by the mining sector strikes in August, September and October. And this has led to a current account deficit of over 6%, which is likely to persist going through into 2013. Now, if you think of a current account deficit of 6%, it means that there's a shortfall of about 200 billion rand which needs to be financed. And this is a problem because historically we could rely on portfolio flows and M&A flows and other inflows to finance our current account deficit at the smaller level. But portfolio flows last year only amounted to something like 80 billion rand and is unlikely to exceed that amount this year, which means that there's a substantial shortfall to be financed. And unfortunately, if this money isn't forthcoming via FDI flows or other inflows, then it means that the rand can only go one way and it's likely to weaken further. But this then poses a question: what does it do to inflation and to monetary policy? Because the economy is fairly open, and we know that typically there is quite a high pass-through from the currency through to domestic inflation. And so the worry is that as inflation goes up, we might see some form of a monetary response. However, over the last year, we've seen that the pass-through from exchange rate weakness has been relatively muted, and that's because of the somewhat subdued demand conditions in the local economy. The consequence is that even though the currency is weak, and yes, imported prices will go up, it's unlikely to feed through substantially into inflation. And what we might see is that the first quarter this year, especially as the new inflation index is introduced, we're going to see an upward tick in inflation. And gradually, as the year goes on, it's likely to tail off. Now, it could breach the 6% target in the first quarter for technical reasons, but we would expect that as we approach the year end, inflation will probably be back to around about 5.5%. So then the central bank will sit there and look at this and say, why do we need to make a policy adjustment when the pass-through from the currency weakness is relatively subdued? And therefore, we expect the policy rate to be left on hold for the foreseeable future. Now, in all probability, the next move by the MPC will probably be a rate hike, but it's unlikely to be this year, which means that it is in such a distant horizon that it probably doesn't really matter from a financial market point of view. So when you look at the bond yields have opened the year basically at historic low levels. And many people are looking at this and saying, but the bond market simply does not pose value and is simply too expensive to be buying into. Now, this is where the point is that if your nominal yields, though, are relatively low, which they are by local standards, however, when you compare them to international markets, they're quite high. South Africa yields are still above most other comparable emerging markets on the one side. And then secondly, when you have a very steep curve, now what matters there is if you decide to buy a bond, particularly in the 20-year type sector, you can get 7.5%, in that area. But you can finance this by borrowing in the money market around 5%. It means that you have this natural carry pickup. And a lot of investors look at this and say, well, that's a substantial differential. They can borrow relatively cheaply, invest it further out the curve, and they then sit and make the carry gain. And this is what will drive a lot of international investors to continue to look at South Africa as a reasonable investment. Now, it's not a risk-free investment because we did say that yields are at a very low point. But for now, if the policy rate isn't going to go up and if the inflation pass-through is going to be relatively subdued, the upside risks to the yields is relatively muted. Outside of extreme rand weakness, which is probably not likely to happen, or alternatively some global event. But besides those risks, and always there are risks, we would still be inclined to be invested in bond yields, probably in the 20-year area of the curve.